You've worked hard to save up some money. Good on you. But now it's just sitting there. And you have this nagging feeling it should be doing more. You hear people talk about investing, but let's be honest, it often feels like a complicated game designed for people with Wall Street jobs and secret handshakes. The jargon is confusing, the options are overwhelming, and you're terrified of making one wrong move and losing everything you've worked for. But what if I told you that turning your savings into real long-term wealth isn't about some secret formula? What if it's a simple three-step plan that anyone, and I mean anyone, can follow? Stick with me for the next few minutes. I'm going to show you exactly how to build your financial foundation and make your very first investment without the fear and without the confusion. This is the beginner's guide you've been looking for. Intro: the silent threat to your savings. Before we jump into the plan, we need to talk about why your savings account, as safe as it feels, is likely losing you money. The culprit is a little thing called inflation. Think of it as a silent tax on your cash. Every year, the cost of stuff, from groceries to gas, goes up. Inflation rates can vary a lot, but for a simple example, if inflation is around 3%, the $1,000 you have today might only buy you what $970 buys you today in a year's time. If your money is just sitting in a standard savings account, earning next to nothing, its buying power is slowly fading away. This is why we invest. Investing isn't about gambling or getting rich quick. It's about putting your money to work in a way that outpaces inflation, allowing it to grow and build real wealth. The goal is to turn the money you earn from your job into assets that earn money for you. And the magic behind it all is a concept called compound interest. This is where you earn interest not just on your initial money, but on the interest you've already earned. It creates a snowball effect that can turn small, regular savings into a surprisingly large amount over time. Starting early is a huge advantage as it gives your money more time to work its magic. But you can't just dive in head first. To do it right, and without fear, you need a plan. And it all starts with one non-negotiable first step. Section 1. Step 1. Build your safety net, the emergency fund. This is the most important step in your entire financial journey. Before you even think about investing a single dollar, you need an emergency fund. This isn't a friendly suggestion. It's a prerequisite for building wealth responsibly. So what is it? It's simply money set aside for life's unavoidable and unexpected messes. A job loss, a medical emergency, a car that dies suddenly. A common rule of thumb is to save 3 to 6 months' worth of essential living expenses, though you might adjust that based on your own job stability and personal situation. Think of it as your financial shock absorber. It's what turns a potential crisis into a manageable inconvenience. Without it, a sudden job loss might force you to sell your investments at the worst possible time, like during a market dip, locking in losses and derailing your goals. An emergency fund gives you the peace of mind to stay invested through the market's ups and downs, knowing your immediate needs are covered. It's the foundation of your entire financial house. Where do you keep this money? Not in your regular checking account, and definitely not in the stock market. The ideal spot is a high-yield savings account. She-say. And Huise is just a savings account that pays a much higher interest rate than the one at your traditional bank. Its main job is to be safe and easy to access, but the higher yield helps your cash better defend itself against inflation, though it's not always guaranteed to beat it. These accounts are typically FDIC insured up to $250,000, so your money is protected. Building this fund is your top priority. Once that safety net is in place, you've earned the right to move on to the exciting part, making your money grow. With your emergency fund complete, you are now ready to invest with confidence. This step can feel like the scariest one, but we're going to make it simple. It's just 2 parts: opening the right account and choosing the right investment. To invest, you need a brokerage account. Think of it as a bank for your investments. One of the absolute best accounts for a beginner is a Roth IRA. An IRA, or individual retirement account, is an account with huge tax benefits. With the Roth version, you contribute money you've already paid taxes on. That money then grows, and here's the beautiful part. When you pull it out in retirement, all of that money, including decades of earnings, can be withdrawn completely tax-free. To get those tax-free earnings, you generally need to have had the account for at least 5 years and be over age 59-12. There are income limits to contribute, so it's a good idea to check the current year's rules with the IRS. For 2026, you generally need to make less than $153,000 as a single filer or $242,000 if married and filing jointly to make a full contribution. But for most people starting out, a Roth IRA is a fantastic tool. You can open one online in about 15 minutes. Part B. Choose the simplest investment. Okay, your account is open. What do you actually buy? This is where most people get paralyzed. But the answer is wonderfully simple. A low-cost index fund. An index fund is a collection of hundreds or even thousands of stocks bundled together. Its goal isn't to pick winners, but to simply match the performance of a market index. The most famous is the S&P 500 index, which is designed to represent about 500 of the largest companies in the U.S. Think of it this way. Instead of trying to find the one magic needle in a haystack, you just buy the entire haystack. With one purchase of an S&P 500 index fund, you instantly become a small owner in hundreds of different companies. This gives you incredible diversification, which is the key to reducing risk. Even legendary investors like Warren Buffett have said that for most people, a low-cost S&P 500 index fund is the best thing to do. It's a set-it-and-forget-it strategy that keeps fees incredibly low and removes the pressure of trying to be a stock-picking genius. You're simply betting on the long-term growth of the economy as a whole. But what about a market crash? They happen. Market ups and downs are a normal part of investing. But history has shown that over the long run, the market has always recovered and continued to trend upward. The key is not to panic. Your emergency fund is there precisely so you're never forced to sell at a bad time. Section 3. Step 3. Automate and be consistent. The secret to wealth. You have your safety net. You've made your first simple, diversified investment. Now for the final and most powerful step. Put your wealth building on autopilot. The true secret to building wealth isn't a brilliant stock pick. It's boring old consistency. And the best way to be consistent is to automate it. Every brokerage lets you set up automatic transfers from your bank to your investment account. You can set it to invest $50, $100, or whatever you're comfortable with every single month without ever lifting a finger. This is powerful for 2 reasons. First, it takes emotion out of the game. You're no longer trying to guess when the market is good or bad. You just invest month after month. This disciplined approach is called dollar cost averaging, and it's your best friend as an investor. Second, it unleashes the full power of compound interest. Let's run a hypothetical example. And remember, these numbers are just an illustration. Let's say you automate an investment of just $200 a month. Assuming a hypothetical 8% average annual return, after 30 years, your $72,000 in contributions could grow to over $270,000. That's the magic of small, consistent steps plus decades of uninterrupted compounding. Actual returns will vary and are never guaranteed, but the principle remains the same. The key is to start, stay consistent, and let time do the heavy lifting. So let's recap the plan. It's not a secret, it's a strategy. Step 1. Build your safety net. Save 3 to 6 months of essential expenses in a high-yield savings account. This is your foundation for fearless investing. Step 2. Make your first investment. Open a Roth IRA and buy a low-cost S&P 500 index fund. This gives you instant diversification and puts you on the path to long-term growth. Step 3. Automate and be consistent. Set up automatic monthly investments. This removes emotion and systematically builds your wealth over time. That's it. That's the whole plan. Building wealth isn't about being a genius. It's about having a solid foundation, a simple strategy, and the discipline to stick with it. Your future self is going to be incredibly grateful for the small, simple steps you take today. Now go take that first step.